Good day. In our last briefing, we provided a brief commentary on the global economy and shared our perspective as to why it will hit the bumps in the quarters ahead. Today, I want to focus a little bit on America. So, what do we see happening in America? The first is employment has never been so good. America is literally on full employment. The official unemployment rate at 3%, and it's never really been lower in the last 40 or 50 years. Wages have begun to rise. The average rise in wages was approximately 1.5 to 2% 3 or 4 years ago, and that is now rising to about 5%. Thirdly, American companies happen to be doing very well. Their profits have risen by about 450% over the last 25 years. And as it happens, American corporations earn $1 billion in profit every 5 hours. But the key issue is this is not going to last because the growth in profits and the growth in margins has begun to taper. And all of this is reflecting in the yield curve. The yield curve is really the difference between long-term interest rates and short-term interest rates. Now, you would normally expect that if you invested money for 10 years, that you would get much higher returns vis-a-vis investing money for, say, 1 year. But what has now happened is long-term interest rates are actually lower than short-term interest rates. And the reason this is so is because the bond markets and the financial markets expect the American economy to slow down, and largely because they expect the growth in American corporations to fall, as well as the growth in consumption to fall. The Fed is watchful of this, and after 8 hikes, it has in fact decided to temper growth hikes and start reducing interest rates. Thank you.